Hi everyone, Joe Gentili from Left Tail Risk Advisors. So in this video, I want to go through a complication that exists for foreign nationals who don't live in the United States but own property in the United States. There are a lot of people who do not live in the United States, and for one reason or another, whether investment, they own a place for their children, or they want to have a place for when they visit, whatever the reason may be, they own property in the United States. One thing that they often overlook is that they are subject to estate taxes, or at least that the value of that property is subject to U.S. estate taxes. And there is very little exemption available for those folks. $60,000 worth of property is exempt. Everything over that is taxed at 40% at the federal level. And depending on the state you're in, there may be state taxes to deal with as well. So this is kind of a unpleasant surprise for a lot of folks that they find out, and it creates a lot of planning issues for them. And so they have kind of a fork in the road to consider if they already own the property. Fork number one is, well, is there any way to avoid the estate tax altogether? And the answer to that is sort of. So the first thing that comes to mind for folks is you could do a few things. You could transfer the property, let's say to your children, or you could transfer the property to a foreign trust or foreign corporation. This way that either you no longer own the property or the property is no longer U.S. property because it's just the assets of a foreign corporation. There's a few problems with that though. So the problems with that are that it may create income tax issues if you own this in a foreign corporation or foreign trust. You could implicate gift tax issues, which are just as high as the estate taxes if you're going to transfer the assets to, let's say, your children, for instance. And there's a lot of compliance and cost issues. So if you have a foreign trust that owns property in the United States, or you have a foreign corporation that does, then you're going to have to pay a small team of professionals to help manage that, both from your home country side and from the U.S. side. So it's certainly not simple. It adds complexities into your life. You could sell the property, but that raises income tax issues, and it raises a law called FIRPTA in the United States where there could be withholding for it. So that's on one side. And for that side of the equation where you're dealing with how to avoid the estate tax overall, that's usually a simpler discussion and more effective, to be frank, when you're looking at planning before you purchase the property in the US. If the planning is purchased by a foreign corporation or it's purchased by a foreign trust, you could avoid a lot of these gift tax issues that exist. You still are subject to the compliance and like the annual complexity of having this and paying for it every year and the income tax issues depending on the property you have, but it's more feasible if you go that route prior to purchase. The other route that's available, so as I described, there's ways to try to eliminate the estate tax or minimize the estate tax. Another route is you could essentially pre-fund the estate tax. So you own the property, let's say you own a $5 million home in the United States, there is going to be a large estate tax bill that is due. If you do nothing, your estate, your heirs are going to have to come up with, let's say it's worth $5 million when you die, they're going to have to come up with 40% of the value of that property within 9 months of your passing. Um, that is a really, really tough thing to do for a lot of people unless they have a lot of cash hanging around to cover that. Usually, the more effective route for folks to pre-fund the estate tax is through life insurance. So, life insurance has a really special place for foreign nationals that don't live in the United States. So, if you have a U.S. life insurance policy, that policy is not considered U.S. side as property, so it is exempt from both income tax and estate tax. So that death benefit from the life insurance policy is paid out income tax and estate tax free. It happens nearly instantaneously with death or shortly thereafter. So instead of paying, the way to conceptualize it is instead of paying the estate tax when it's due, you could essentially prepay that in the form of life insurance premiums, which are going to be much, much less than the estate tax. And so, yes, the estate tax is still due, it still has to be paid, but you could take care of that through life insurance premium payments as opposed to just looking to have all that money free upon death. So life insurance is a very attractive way and a simple way for families to deal with that estate tax issue if they already own property. If they don't own the property, then really you're doing like a comparison between, there's not necessarily a right answer here, but what do you prefer? Do you prefer to have the income tax issues that you're going to deal with if you buy the property in a foreign corporation, along with the more complicated and frankly more expensive compliance issues that come with that? Or would you rather have the estate tax issue, you have less income tax complexity, you have less ownership complexity, and you pre-fund that estate tax? You're going to pay the estate tax, but you pre-fund it with life insurance. So part of it is financial, just kind of doing the math side by side to see which works out better. And part of it is psychological. Do you prefer to have, let's assume that it works out to be less money with the foreign corporation route? Do you prefer to have that more complicated structure to, take up some of your time every year and some of your money, or do you prefer to have the simpler structure with life insurance? So, again, no right answer, but there's certainly pros and cons to either approach. Another approach that some people take is that your estate taxes are due on the equity that you own in the property. So some folks, instead of having a lot of equity in the property, they basically look to have a mortgage on that property as high as possible for as long as possible. So this way they don't have the estate tax issue to deal with in full. They're going to have some equity in the home, but then that tax is only due on the equity portion. It's hard to say whether that approach really makes sense for most people because depending on how long you live and depending where interest rates are, and they're going to fluctuate if you live a long life, there is going to be a huge amount of interest payments that are paid over time to effectuate that strategy. So kind of hard to see situations where that would work out for most people's benefit. So it's why it's not a popular strategy. I think most folks either go with the foreign blocker setup pre-ownership, or they go with life insurance post-ownership. Those are probably the most popular options. Complicated topic. If you have any questions on this, please feel free to reach out. And if you felt like this video was useful, please like and subscribe for future ones. Thanks.